Well, good morning, West Coast and Central U.S., and good afternoon to the East Coast and everybody in between. My name is Brad Etheridge. I'm the Chief Marketing Officer for the Center for Tax Strategies and Resources. For those of you not too familiar with us, we are a membership-based organization. Some people have said we're similar to a study group on steroids. Our members have access to some phenomenal talent from our industry, including top CPAs and tax attorneys, as well as top producers in just about every area or field related to financial services. And folks join our group to have access to those people, as well as gain training on techniques, proper words and timing, closing, better ways to market your practice. Kind of like a virtual sales office for our members. Today is an example of that. Leading up to our Academy events, we always do a series of webinars, or what we refer to as kind of vignettes, where it gives you a little bit of an idea of the type of talent that our members have access to. Today will be no exception to that. As the members know, this won't be a complete webinar with all the answers and facts, because we really like folks to be members to get all that. For the members of our organization that have joined this call to brush up on the topics, remember you can view the entire webinar on our website through the member portal. For those of you that are guests, we'll jump in a little bit later and kind of give you a little better understanding of what it takes to be a member, why somebody would want to join, and the other tools and talent that you'd have access to help grow your practice to the next level. So with that, I certainly hope you enjoy the webinar. Again, I'm Brad Etheridge, Chief Marketing Officer, and we are so proud to have you on our webinar here today. Thanks.
All right, so thank you very much for allowing me to speak to your august group of folks. I appreciate it very much. The advantage of this topic today is that it is one of the few situations in which the client must buy life insurance. It's nice to have a situation where it's not optional, it's not nice, it's not helpful, but the client absolutely must buy life insurance. And to make it even more attractive is you can sell life insurance even if the client is uninsurable. So it's a very attractive situation for members of the center. Let's figure out how to get into this topic to make it comprehensible. It is estate tax planning, and the way I like to describe it is to compare it to something that would be really good estate tax planning if you could do it, which you can't. So imagine that you had a 96-year-old father, which shows up on page 1 of my materials. Wonderful estate tax planning would be if you could have the 96-year-old father loan $10 million on a 50-year interest-only installment note to his 60-year-old son. And let's say the interest rate was 2%. That's not exactly the long-term applicable federal rate right now, but let's round it to 2%. So let's say the father lives for 10 years to the nice age of 106. I'm not wishing that he dies then, but just let's make our math simple. So father dies at 106. What happens? Son hires a business appraiser to appraise the value of a 50-year note at 2% interest with 40 years left to run. I don't know what the value of the note would be. It would certainly not be $10 million. It would be something significantly less. Whether that less amount would be a 50%, 60%, 70% discount, 80% discount, I don't know. But we all know that it would be some significant discount because it's interest only. Probably the interest rate 10 years from now will be higher than 2%. Well, actually, we know, because the applicable federal rate, which we're entitled to use, because if we use the applicable federal rate, the IRS cannot argue that there was a gift. And we know that the IRS applicable federal rate is always below the market rate of interest. So let's say the market rate of interest goes up higher than it is today. I don't know what the market rate is. Let's say it's 4% on a 50-year note. So if it becomes 5 or 6%, the discount's going to be much higher. So it would be great estate tax planning if you could have the 96-year-old make a 50-year loan at 2% interest to his 60-year-old son, because you'd get this very large discount, 60, 70, 80%. However, you cannot do that.
So Bruce, let me interrupt for a second.
Please.
So by discount on that $10 million, if it was a 50% discount, you're saying that only $5 million would be taxable in the estate and the other $5 million would be free, right?
Terrific, thank you. Please pipe in anytime you can to make what I'm saying more understandable. So in what you said is absolutely correct. So the $5 million discount eliminates 40% of $5 million, $2 million of estate tax. And I'm not going to, in this discussion, talk about the legislative proposals by President Biden or Senator Sanders or, oh, now I can see it on the screen. Thank you, Todd. Aha. And I go up in that thing.
Bruce, I'm in control right now.
Oh, terrific. Okay. Thank you, Todd. Or Senator Van Hollen. I'm just going to stick with today's 40%.
It's like he was Kathy, Bruce.
Okay. The 40% estate tax rate. So the reason why you cannot do that, and this is in my materials, we'll see it on a separate slide, so you don't have to write it down, is Internal Revenue Code section 2036. And 2036, which again is in the materials, you don't have to write it down, is the major tool that the IRS has to challenge estate tax planning structures and say, no, 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 that is included in the parent's taxable estate. And the reason why it's included in the parent's taxable estate when you do a 50-year note for a 96-year-old is because the parent has transferred something but retained the right to the income for a period longer than the parent's life expectancy. Well, at 96 years of age, I don't know the exact life expectancy on an IRS table, but it's probably something like 3 years. So if we only did a note for 3 years, that would be okay under Internal Revenue Code section 2036, but we wouldn't get a very big discount compared to a 50-year note. So what I say to the clients is, gee, it would be nice if we could do this 50-year loan for your 96 or 86 or 76 or 66-year-old parent, but we can't do that because the note exceeds their life expectancy according to the IRS table. However, there is a way to get us something close to that, and that is called generational split dollar, which you can see at the top of page 1. What the heck is generational split dollar? Well, we know that split dollar is something that is heavily regulated by the IRS and regulations. 1.61-22, I think it's written someplace in my materials, and there's other regulations as well. And we also know that there are 2 regimes in split dollar. One is the economic benefit regime, and the other is the loan regime. And we'll talk about that later. But the basic idea of split dollar is, as you probably know, is that you can contractually divide the contract in different ways between 2 different people. You can have one person pay the premium and the other person own the policy, for example. You can have someone own the cash value and someone own the death benefit. There's different ways to do it. But the key point for our purposes is going to be that generation 1, and there's 3 generations in this structure. Generation 1 is going to be our 96-year-old, the grandparent. Generation 2 is going to be the child, and generation 3 is the grandchild for whom this structure is to benefit. Now, there are times when there is no generation 3 and the benefit is for generation 2, but archetypically, it's G1, G2, G3, grandparent, child, grandchild. And the person we're really trying to help is G2, the child, to save estate taxes when the grandparent, that person's parent, dies. So let's look at this example on page 1. And I guess let me make a few more introductory comments. The reason strategically why generational split dollar is helpful in estate tax planning is because we have only so many ways to reduce the value of the estate. Obviously, life insurance is helpful as a way to provide the revenue to pay the estate tax. But before we get there, it's nice in estate tax planning. Notice I say estate tax planning as opposed to estate planning. Estate planning is who gets what and how do they get it when you're gone. That's wills and trusts. I don't do that much estate planning, but I do a lot of estate tax planning, which is how do you take 100 million or 50 million and reduce it to as close to zero as you can to save estate taxes for the next generations. So there's two ways you can reduce the estate to zero. One is the lifetime exclusion. In my materials, we use last year's exclusion, but this year we know it's 11,700,000 per parent. That's one way, because that's 100% reduction in the estate. The other way is something called a private annuity. Well, I'm not going to talk about private annuities right now, but a private annuity is basically a fancy installment note where the children pay a little bit extra. And because they pay that little bit extra, the minute the parent sells something to the children for a private annuity, poof, magic, the parent's estate is zero. We don't talk about skins because skins are chancy because it's not clear that you can use the Section 7520 rate in connection with a skin, whereas it's absolutely clear with a private annuity because private annuities are statutory. But in any event, let's go back to what I was saying. The exclusion, the 11,700,000, that's a 100% reduction in the estate. A private annuity is a 100% reduction in the estate. What other reductions in the estate do you have? Well, a family limited partnership, if the underlying assets are liquid, stocks and bonds, will get you about a 30% reduction. A family limited partnership, if the underlying assets are income producing real estate, will get you about a 40% reduction. And if you have a closely held business and you're transferring a minority interest in a closely held business, that'll get you 45% discount. So between 100% and let's say 40%, what is there in between? Generational split dollar, because the discount could be 50%, 60%, 70%, 80%, depending on the age of G2, because it's the life expectancy of G2 that fixes the note on which the parent is loaning money to G2. So the younger G2, the longer the note, the longer the note, the bigger the discount. So I'm going to be done with the introduction with this point. Imagine you've got the parent with $10 million of assets. Let's say it's income producing real estate, and you throw that 10 million into a family limited partnership. And
Bruce, let me interrupt for a second.
Please.
The 10 million now, the exemption has already been used, yes?
Yep.
And so now you've got 10 million that's going to be taxed at 40% without the planning, correct?
Yes, absolutely correct. Thank you for making that clarification. Yes. So you got $10 million, as Simon said, above the exclusion. You throw it in a family limited partnership, and because the underlying assets are income producing real estate, it has a gift value of only 6 million. Now let's say you can use that 6 million in connection with a generational split dollar. And let's say G2 is 40 years old, where you're going to get, let's say, a 70% discount. Well, if I've got 6 million and it's only worth 30% of 6 million because I got a 70% GSD discount, let me think. 30% times 60% is 18%. So the combination of the two is an 82% discount. That's very attractive if you're trying to reduce the estate tax. So that's enough of an introduction. Let's look at the diagrams. So the first diagram reiterates the point I was trying to make initially, which is you've got the 96-year-old father with a $25 million estate. You can see right there that the exemption is last year's exemption of $11,580,000. But the basic point is that even after the exemption, as Simon was trying to point out, there is some taxable estate, okay? So that's the problem that we're facing. When we go to the next diagram, so the desired plan, of course, is that the father dies in 4 years after a note. The son hires an appraiser, and we get this very significant discount. And in this example, this is really a pre-Morissette 2 discount because I'm using 90%, and we're going to talk about Morissette 2 in a second. But this shows the advantage of the long-term note in helping get the estate down to 0. Okay, now we go to diagram 3.
Well, this seemed like a pretty good place to kind of jump in. Hope you're enjoying the program so far. You know, I've been doing this for 37 years, and I absolutely love our industry, and so does the rest of the team at the center. That's one thing we all have in common. We don't really feel like we have to work for a living because we enjoy what we do. Question I've got for you in the audience is, when is the last time a single idea added $50,000 or $100 or $150 or $300,000 to your practice revenue? Think about it a minute and realize that our members can say that they have that happen on a very regular basis. The reason folks join our group is to get ideas and concepts and training and techniques and better ways to market their practice. This is a very interesting organization because we don't have an axe to grind. This isn't an IMO hiding as a training organization. It's a training organization that just happens to know a lot about our business. We have an event coming up called the Academy. We're going to be holding it toward the end of January, early part of February. We'll announce the date shortly. That is a 3-day program where we bring in unbelievable talent. They will bring new ideas and concepts and techniques and tools to double or triple your practice revenue. If you join or if you don't join our organization, you will walk away with ideas that can add a lot of zeros to your practice revenue. So pay attention to the announcements at the very end. We'll give you an email address too if you want to ask some questions about what you've heard, or if you want to find out a little bit more about why somebody would become a member or try to become a member of our group, or a little bit more about the Academy. You can reach out to me. We'll make sure we've got my email address up there. So enjoy the rest of your program.
So this is the problem that I posed, and this is the citation to and quote of section 2036. It says the value of the gross estate shall include the value of all property to the extent of any interest therein of which the parent has at any time made a transfer without getting full consideration. In other words, the parent made a gift and has retained for life, or for any period not ascertainable without reference to his death, or for any period which does not in fact end before his death, the possession or enjoyment of, or the right to the income from that promissory note. This is why you can't do a note for the parent's life or longer than the parent's life expectancy. So now we go to the next diagram. So here's the solution, and this is the citation to the SplitDollar insurance regulations. So if you want to read them, they are there, and they actually have very good information for what we're going to be talking about, which is the loan regime. And when we talk about the 4 cases, all of which are against the taxpayer, they were not the loan regime, they were the economic benefit regime. And as we'll see in the Cahill case, the 3rd of the 4, the judge was making very favorable comments about the loan regime. So let's go to the next diagram.
So instead of PS58 costs and there being no loan against the estate. There's what's called the economic benefit costs, which is the government's version of the annual renewable term that pays for the life insurance death benefit. Yes.
And that's what was used in these 4 cases as a way of reducing the value of the parent's estate. So they were not using the loan based on the child's life expectancy. They were using the economic benefit as you have just described. So the first case, what we now call Morissette 1, because the case that just came down a month ago was Morissette 2. So the first case was April 13th, now 5 years ago. That's how long this has been going on. In the first case of Morissette, what mom did is she gave $30 million to trust for her sons. And the trust used the $30 million to pay premiums on the lives of what I think were 4 sons. And what the trust did is, what the estate did for Mrs. Morissette is the estate took a 75% discount and the sons were in their 60s. But the first case was not a decision on the merits. What this case held in April of 2016 was that the taxpayer was entitled to treat the transaction as split dollar because the IRS just said, nope, you're not entitled to split dollar treatment. And the court said, well, actually, after all, they are entitled to treat it as split dollar. They followed the IRS regulation. So it wasn't really a very momentous decision other than slapping the IRS's hands. So May, June, July, 3 months later came the estate of Levine. And the estate of Levine was a taxpayer victory, but not terribly meaningful because, again, it just said that the structure was entitled to split dollar treatment. So nothing happened for another 2 years until we had the estate of Cahill. Now, the estate of Cahill, we should move the diagram down a little bit, was a disaster for the taxpayer. Again, an economic benefit regime case, just like the prior 2, but terrible facts. I mean, dreadful facts. So the parent was quite elderly. The parent died almost immediately. The children were on both sides of the transaction. I mean, all these are bad facts. And the children did not have a non-tax motive for the transaction.
And Bruce, am I right in saying that the Internal Revenue Service always challenges bad facts?
Yes, thank you for saying that, Stuffy. Yes, when you read these cases where the taxpayer loses, when you read them, you say, how could someone be that dumb? It's just, they're bad facts. And this is the case where the judge made positive comments, but we'll get to that. Let's go to the next page and scan through some of the bad facts. So what you can see is the son was on both sides of the transaction. One of the worst facts was that the insureds could terminate the arrangement at any time. That was a bad fact. The father borrowed money from an outside lender, and it was repayable in a very short period of time, which gave the judge the view that this wasn't really designed to be in place for the term of years that you expected it to be in place. So it didn't seem like a long-term transaction, therefore it wasn't entitled to much of a discount. The ILET used the advance to pay a single premium on each of the policies. The judge didn't like that, but the father died within 1 year. And that was the primary thing that plus the size of the discount, plus so the father dying within 1 year, the lack of a non-estate tax motive, and the 98% discount, those were the things that really irritated the judge. The 98% discount just didn't work. The father dying within 1 year just didn't work. The fact that there was no motive other than saving estate tax just didn't work. So that was 2018. So to this point in time, what we knew from audits was the IRS didn't like generational split dollar. However, in audits with the economic benefit regime, we were able to settle at the audit level. We didn't even have to go to appeals. And we were able to get 50 cents on a dollar for all the discounts that we took. And it wasn't just our firm. We talked to colleagues around the country, and they were having the same results. So the IRS is treating the loan regime quite differently. And if you started off with a 75% discount and the IRS settled at 40, we still had very happy clients. Finally, the other shoe dropped, which is Morissette 2, which just happened literally, today's the 14th. This was May 13th. It was just a month ago. This case, Morissette 2, which is the follow-up to Morissette 1. Remember, in Morissette 1, what happened is the court said, yes, you're entitled to split dollar treatment. And the IRS didn't like that. They wanted to treat it just as a straight gift of $30 million. The taxpayers won on the merits, which I'm going to describe, but they lost on valuation, which I'm going to describe. And this case is really good news all around for our taxpayers. So let's talk about the win on the merits. The judge rejected the IRS's attack. The IRS's attack primarily was based on Section 2036, that it was a transfer with a retained income interest for longer than the taxpayer's life expectancy. The judge said, nope, it wasn't. And there were 2 other code sections. We don't have to go into those, but the judge was persuaded that the taxpayers had a substantial non-estate tax motive for this structure. And that was the win. And that is the clear takeaway from the case. You have to be able to prove, to articulate, to, just repeating myself, substantiate a non-estate tax motive. Now, the judge said and by the way, what it was is that mom, really grandma, was concerned about the succession of the children to the closely held business. It was a very successful closely held business, and the insurance policies on the sons provided liquidity to make sure that the business transition from generation to generation would go smoothly. That was clear from the documents. It was clear from the testimony. No one, the IRS argued, but it was very, very clear. They took the witnesses that the taxpayers put on as quite credible. And the judge made 2 points that are very helpful. The judge said the significance of the non-estate tax motive does not require an absence of an estate tax motive. So it's okay if you also had an estate tax motive, as long as it was not the most important one. That was very important. And number 2, the judge said the fact that the advisors may have had an estate tax motive does not take away from the taxpayer's non-estate tax motive. Well, this, of course, lays the groundwork of how to prepare these cases, because you must assume that there is a 100% audit rate, and that the auditor is an omniscient and omnipotent being. So you do not enter into these cases based on the audit lottery. That is strictly impermissible. Your client must enter into this kind of a structure on the assumption of a 100% audit rate, a 100% challenge rate. So you better document it properly. And there are many permissible and previously accepted non-estate tax motives that have been validated over the years. You can look to the family limited partnership cases that have been victorious. For example, I think it was the Stone case where the family limited partnership was done to minimize the amount of post-mortem, meaning after the parents are gone, sibling litigation. They set up one family limited partnership for each child and divided the assets among those 4 family limited partnerships to get rid of the sibling litigation, which had already occurred. There was another case involving a member of the DuPont family, the name of which I do not remember at this moment. And the non-estate tax motive was.
Well, I hope you enjoyed the mini webinar here. Again, just a reminder to those of you that are members that are on this webinar, you can go to our member portal on the website, yourctsr.com. Put in your credentials and you can watch the entire video at your leisure and playback parts that you need to have more clarity on. For the rest of you, hope you enjoyed this. Listen, these webinars are done to entice you to find out more about our organization. It is unlike anything that we're aware of in the industry right now because we don't have a product to push and we're not an IMO pretending not to be. It is about education. It is about building some unity between independents. It is about increasing the marketing for your practice and making you better at what you do, being able to offer your clients better solutions. We like to say that our members are independent but not alone. If you want to find out more about our organization, more about the event I talked to you about earlier, the Academy coming up, I'd be happy to communicate with you electronically. My email's on the screen right now. Feel free to reach out to me. I'll reply to you pretty quickly. And if there's something we can answer questions for you, want to find out more about the upcoming Academy or find out more about membership, please feel free to drop me a line, brad@yourctsr.com, and we'll start up a conversation. I wish you success and health and look forward to seeing you, hopefully seeing most, if not all of you in Vegas in a couple months.